Hey Chinchillas, this is Dave and Brandon coming at you again for another week of the Chinchilla Pickin' Podcast. We always hope to be entertaining, educational, and uplifting because we want everyone to make money. It is June 17th, 2021. Brandon, how are you doing tonight?
I'm good. How about you?
I'm doing well. The heat kicked in here. We are in Cincinnati, Ohio, in case you don't know, and the heat just came right in with a rush, just as all these cicadas around here are falling over dead. So you have piles of dead cicadas with 90-plus degree heat.
I still think they're cute. I'm glad they're not around, though, as much, because they attack me when I'm cutting the grass, and it's annoying.
I've had a few, seriously, I've had a few of them hit me in the face as I'm walking down the street, just come flying out of nowhere, hit you sideways.
I had one land on my nose.
Yeah. It's been crazy with the cicadas, but just like a lot of stocks, the cicadas have come, they exploded, and they're coming back down.
Yeah.
So tonight, guys, rules. Let's go over the rules. Everybody knows the rules. Brandon and I get together about 5-10 minutes before the show, and we tell each other what we're going to talk about. We don't actually talk about it. We wait till the show to talk about it. That's when we discuss. You guys hear the live interaction and discussion and argument, if there is any, on the show here in front of you for all of you guys to hear. We appreciate you listening. Here it is. Tonight we discussed who was going to go first. It was actually going to be me because we actually have a big topic that we feel we're going to spend a lot of time on, that we both have the same topic. So that's kind of where we're going to lead in with this. And I'm going to take the lead because I have a different lead in than Brandon does. So we're hoping that we meet up and transition smoothly from one to the next here with this. So Brandon, what I wanted to really reach in and how I wanted to transition into what we agreed upon was I wanted to do it from the standpoint of oil. Start with oil and then slowly transition into what we're going to talk about, which is more about the Fed minutes, the Fed meeting, and where they were headed and their policies. And so what I want to talk about oil is it has a lot to do with this, all right? Oil prices have been going up. Everybody notices it, right? We all see it at the pump. We all hear about it on TV constantly. This is something we are seeing right now affect us immediately, right? Where I think this is coming from twofold, right? You have the push for green, which has made oil companies reluctant to invest in oil fields and open up the rigs. You also have the rig count that is open and flowing, which could be from that push for green, and it could be we still haven't released it from pre-pandemic. So pre-March 2020, the amount of active rigs in U.S. controlled territories, seas, land, what have you, was 700 plus. The current active rigs in U.S. controlled territories is 400 plus. That has a lot to do with the price of oil being up because supply is down. So thus demand is up. You know, supply, demand, we all went to high school. We know that means higher prices, right? So that has a lot to do with it. And OPEC can't just start pumping out right now because they're still not at, quote unquote, massive profitable domain yet for the price of oil. They need it above 75 a barrel is where they want it. OPEC does before they start pumping out more. They can pump out more, but they won't until they get above that $75 a barrel, especially the Saudis, because they have the Saudi Aramco that was meant to go public, an IPO, and it turned out to be a horrible mess. It wasn't that well financed, and now oil just dropped in price tremendously. They were hurting. And Russia just kind of, sometimes they'll say, yeah, we'll pump out more oil. Nah, we're not going to. Psych, we got you. Russia's playing that game. And as Venezuela keeps pumping out as much as they possibly can, they'll keep doing that until it hits 4 cents a barrel because they need the money that desperately. So it's kind of a big mess right now in the oil industry. I'm going to stop talking for a minute because I've controlled the conversation for 3 minutes here. Give me your thoughts right now on just what I said, because I got more figures here But give me your thoughts on just that.
Well, OPEC's all about creating value for their members. Russia is all about using oil as a political ploy. So it's a negotiation technique for them every single time. And you're right about Venezuela. We also have the situation with the dollars dropping in value, so that's leading to increased oil prices too. And that's coinciding with the American summer here, where everybody that wanted to travel is going out and finally traveling. Well, most people are, at least. A lot of people. I've got a vacation planned for the summer. You've already been to South Dakota. So there's a lot of people hitting the road and a lot of people getting on the airlines, and that's driving up oil as well.
Right, and also, so you brought up the U.S. dollar. The U.S. dollar gained the past 2 days. Why did the U.S. dollar gain? Do you have any ideas, Brandon?
No, I just wonder if that was kind of like maybe a bounce. You know, it's suffered so much the past 6 months to a year that maybe it's just a relief bounce.
I thought so as well, but then I read in that China was agreeing to release reserves of some of its commodities. So it's flooding the market with commodities right now. And it's helping the U.S. dollar gain strength. And that way it creates a better trading atmosphere for China. Because China needs a strong U.S. dollar and a weak Chinese monetary policy. And some of the bigger ones, the two biggest ones that China's releasing are copper and aluminum. They're releasing all the reserves of copper and aluminum. So they're flooding the market with commodities right now.
So that makes me wonder if they think copper and aluminum might be overvalued at this moment, and they're taking advantage of it.
Well, you got to think now, China plays the long game, right? We all know that. They play the long game. They want to keep their currency devalued, and they want to make sure that it's so cheap for other countries to build products there, so they get the business, they get their economy rolling, and they can ship out and be an exporter. They want to be the exporter nation. That's what they want.
Well, I think
so they want a strong U.S. dollar. They want that.
It's interesting. It might not be for the same reason, but I'll skip ahead a little bit here because I was going to talk about this. Jefferies is actually winding down its merchant banking portfolio, in which it is getting rid of its oil and gas investments, its Idaho timber investment, and it is getting rid of its telecom and all that. But I just find it interesting that they're offloading timber and they're offloading oil and gas too. They're also offloading real estate assets.
I can understand the real estate, the timber. I can't really understand the oil and gas yet because you still have almost 100% of all trucking is oil. How is that? And that's how we get our goods around this country.
Well, maybe they're thinking because, the future is electric, or that's what we think it is at least, and investors invest for the future that, eventually the oil price, and maybe even sooner than we think, will start taking a hit just because people are investing for the future. It's possible.
Yeah, but here's the thing with the future of trucking, you only have one company with one route that's doing electric trucking, and it's Tesla, and it's going from Arizona to LA, and that's it. That's all you got right now, man. So I don't see a big, bright, quick future in it. Oil still has a big place to play here in the United States. I know they're pushing all these electric cars. Everybody's going to have electric car. What about all the millions of Americans who live in townhomes, who live in condos with no garages, who live in apartments? Mm-hmm. What about all the millions of Americans who don't have access to plug in their electric cars safely? What about them? Are they just going to be left out with the old gas guzzlers as every car goes electric? I mean, are we even thinking about that? There's got to be some way to make it all work. And right now, there's no charging stations that are security protected to where you can have your own charging station in an apartment complex parking lot.
Yeah, that's the only way to do that.
Yeah, you got to have like a pin pad or something to unlock it and get it to work. That doesn't exist right now. That's why I like companies like Blink Charging. I think they're on the verge of moving along in that route and growing in there. I say they're a good long-term play. You can also swing trade them time and time again as they go up and down throughout this long-term drive. But, oil is still going to be there, man. I see oil good. The rig count has me questioned, though. That rig count number is a big separation still from March to now. And that tells me that, like APA Apache, we all know that. That's a company that out there that they do oil rigs in the ocean. Apache still hasn't recovered back to $40 a share. They're still sitting at $21 a share. Why is that? Are they a majority of this rig count that is not back to full capacity? ExxonMobil still not back to pre-March 2020 costs and price on their stock. These oil companies still have more movement.
Are there shortages of equipment?
No. When they put a cap on them because there was no supply, because the world shut down for a few months, they never took the cap off all of them. They're inflating the price of oil with the weakening of the U.S. dollar, with the inflation of the U.S. Dollar. All those three combined has driven the oil price high. The oil companies are laughing right now because they're making money hand over fist. They were making money at $45 a barrel. Right now, was the last time I saw 75?
Yeah, close to right around there.
Close to it. I mean, come on. These companies are just making tons of money, and they have the best part is for them, Brandon, is because these rigs just have caps on them and they're ready to go. They don't have to put any more money into building new wells for a while, because all they have to do is just take the safety caps off some of these and flush them and get them going. They're already set in place. They're already built. They're already ready to rock.
So would you say APA, could that be possibly a buy right now based on value and the fact that it hasn't caught up with its peers or caught up with the price of oil at least?
I would say yes, but then it's going down today. So then now my honest answer is I don't know.
Well, oil
that goes into what we're going to get into at the end here.
Yeah.
But like it's like I don't know. Why is it down today? Oil went down a little. Yes, went down a little.
Was there anything in the Biden-Putin meeting that had anything to do with the increased price of oil, or
not that I'm aware of? Not that I'm aware of, man.
Huh.
Not that. See what I'm saying? There's just too many unanswered questions here. I think it has all to do with the U.S. dollar, and the U.S. dollar that has a lot to do with inflation, and that brings me into QE. You had the Fed coming out the other day, and they're talking. They're just talking about, mentioning, possibly thinking about. I don't know the terminology that he's using over there. He's being evasive as he can be. But everybody's saying the last time that they were using this type of terminology, it was only a couple months before they started tapering down on their QE. So if they start tapering down on the QE, what does that mean? What did they spend this QE on? We covered this last time. Last time it was $120 billion a month is spent buying bonds and mortgages.
Mm-hmm.
So what happened today in the mortgage market? The mortgage rates went up. Just based off the Fed's comments from yesterday that they might possibly be thinking about tapering QE, mortgage rates go up. Why? Because now the Fed's is saying they're going to slow down to how many mortgages they're buying. So now they're not 100% sure they're going to be secure. Well, my question is, if these mortgages weren't 100% secure before, and you were just giving out mortgages because the Fed was just going to go ahead and buy them, how many of them are going to fail?
That sounds familiar. Awfully familiar.
Let's just give out a mortgage to anybody because the Fed's just going to buy it.
I feel like we've been through this before.
So, yeah, right? I know. It's ringing bells. And so right now, when the Fed says, hey, we might slow down to how many mortgages we're buying, the bank's like, uh-oh, we better raise our rates, make some more money to cover our losses. I don't know, man. I don't. That's just my intake from what I've seen the past few days.
Here's my prediction. Watch it. Because, I mean, I know everybody wants to pretend that the Federal Reserve is independent and they're a private company and everything, but to pretend that they're independent from politics, that's sort of like watching WWE and pretending it's real. That's okay.
Seriously.
So here's the deal. My prediction, they're not going to start tapering until they get an infrastructure bill. And maybe even until they get the funding for it, because they don't want to make it harder for the government to borrow. That's my opinion. That's my prediction about this.
Now, here's my question to you, Brandon, Mr. Bonds Are Dead. If the Fed stops buying bonds, are bonds dead?
Okay, so at this point in time, yes, because you don't want to buy a bond right now at 1.5% and then have the interest rate shoot up to 2.1 or whatever they would go up to. But at that point, you could start watching it and looking for maybe some long-term safety nets if they do go up. I hope they do. I made an investment this week in a company that we'll talk about later, based on the fact that I think they're going to have to taper. They're going to have to raise the Fed funds rate. Looks like that's going to maybe happen in 2023 now. I think it'll probably have to happen sooner. So I made a long-term investment in a banking company based on that. I do think that bond rates will go up. But that means that even more, at this moment in time, they're dead at this point. Because you can't buy a bond rate at 1.5% and then sell it for a decent profit when it rises.
It's true. It's true. I have to agree with you on that.
But one day, Dave, one day.
No, bonds are dead.
Even at 2%.
That's my favorite episode from you on this podcast. Is the Bonds Are Dead episode by Brandon.
They're tradable, but there's no... I mean, because you could buy, a bond now maybe if you think that rates are going to go down a little bit further, and then sell them when they go down a little bit further, make a little bit profit doing that. Maybe you bought a bond when rates just a couple of months ago were at 1.7%, and you're selling it right now when rates are down at 1.5%, and then you're going to make a profit off that too. But buying it to hold it makes absolutely no sense. None. I mean, the producer price number for last month was 6%.
Yep.
Somewhere between 4.7 and 5% for the CPI. So
there you go.
Is it do you think it's temporary?
The inflation?
Yeah.
I don't believe it's transitory. No.
Yeah.
I believe it's more permanent as long as we keep pumping out these bills the way we do. Then yes, it's going to be more of a long-term issue.
Jamie Dimon thinks there's a good chance you're right.
Look at that. Hey, guys, I am in the same group as Jamie Dimon. I'm dropping my pen. I'm walking away from the mic. I am calling it a career.
JP Morgan's hoarding cash right now because of it. You'd think they go in the other direction, but...
I don't see. It's that what? That goes into my next comment I was going to make, and it plays in perfectly. I was going to say, guys, a couple months back on the show, I said, buy NVIDIA. It's a great hold. I believe it was around $575, $600 a share at that time. Right now, it's at $750, $770. I sold. I got out my long-term investment with NVIDIA because I see some uncertainty in the future, and I was worried. So I took my profit, which was a hefty profit. I enjoyed that $200 a price swing there, and I got out, and I'm just wondering what to do with my money, because this goes into my next question, Brandon, and I'm going to put this out there for you. I have my thoughts. I know you have your thoughts. Why is there no clear signals right now in the market?
There's no clear signals in the bond yields. There's no clear signals from the 10-year rate, which is the benchmark. That's the dashboard of the U.S. stocks plane, basically. We're flying right now without any indicators. They don't exist. They're broken. So, I mean, how much sense did it make for bond yields to drop below 1.5% on the 10-year after the inflation came out at least 4.7% for the CPI. It made no sense whatsoever. That is broken. That is a broken indicator. And it could also be maybe, we're in the dog days of summer. That's a thing. It's pretty common for the summer to be just like a sideways summer for stocks. That's very common for that to happen. So those two things mix. That's my opinion. I look at the 10-year yield and I see nothing. I see nothing.
Yeah, I'm not seeing much as far as like stock picking evidence out here of which way to go, where to buy. I'm with you. It's a sideways. It's the hot dog days of summer. I'm not seeing a whole lot of. I mean, dude, the only thing on CNBC today was the Reddit. There's the Reddit crowd because they didn't have any big news of where to go with stocks and how to pick the right things. So they had the Reddit guys on there talking about AMC, and it's jumping up.
Yeah, right now we're just
the Reddit guys that are the only ones who calling stock picks right now.
Yeah,
besides us.
Everything's channeled. Everything's bouncing up and down within its support and resistance levels, which are pretty narrow. And the only thing that I see that seems to be a decent predictable pattern is the fact that one day you've got tech stocks, the next day you've got value. And people constantly just keep cycling between the two. And the market can't decide what the next leader is going to be. But, I think you got bank earnings coming up in the next few weeks. So hopefully we'll get a clearer picture and be able to move beyond it.
There you go. With that, Brandon, I pass the torch on to you. My time of controlling the show is over. It is you, Brandon.
We're still I'm still talking about the same subject here. Projected 4.
Yeah, but you have different view on it.
Yeah,
you didn't fully go into that, so go into that.
So there's not much of a change here. We thought that a lot of people thought that the Fed would start to raise interest rates. It looks like they're talking about raising it from where it's at right now. The federal funds rate's an average of 0.1%. They're going to raise it to an average of 0.6%. It's going to happen in 2023. Some people, analysts, apparently thought that it was going to happen in 2024. The last Fed meeting, they said that they saw no changes through 2023. But I think a lot of us expected 2022. We thought that it was going to happen a lot sooner. So to me, it's no news. They're talking about tapering. They're going to have to taper before they raise the rates. Otherwise, they're just going to be fighting themselves. So it would be stupid to not do so. So the tapering will happen first. Yep. I think it's going to happen probably after they get a deal on the infrastructure situation and after they secure funding for it. And if they do start tapering before, it's going to be very small because they don't want to stand in the president's way because they're not as independent as what they claim to be. They haven't been, at least for my lifetime. So where are we now? We're moving sideways. To me, I think actually it's a good thing because we did get overheated. Financials lately got overheated. Now we're giving earnings a chance to catch up with valuations.
Now hold on, we covered on this show why financials got overheated. I actually made the call. I said, when the financials report next week, they're all going to have great earnings because they blew it away last year because of the huge runs in the market. These are smart guys behind these financial companies. They're not dummies. They see the market crashing. They move funds around. They allocated the best. When they bottom out, they went in, they bought. They made a ton of money on the way up. These are smart individuals here at these financial firms. I said, look, when a few months back, I said when they go to report their yearly earnings, they're going to have great earnings. They're going to jump up in price. It's going to be awesome. I said it was going to be a short-term thing.
Yes.
Why? Because they can't repeat those same earnings this year. Those were blow-away numbers last year.
Which is why
they can't do that.
It's funny, and I've never seen this personally before, with good stocks at least. But if you look at the trailing 12 months price to earnings ratio, the trailing 12 months price to earnings ratio is actually lower, often by a lot, on a lot of these companies than their forward PEs are.
That's crazy.
Yeah, it's because the earnings growth isn't going to be as good in the next 12 months as it was in the past 12.
and it's not. It's not. They're not. The year-over-year comparisons is going to be crazy for the financial companies over the next 6 months.
Mm-hmm.
You're going to see some huge differences.
I will say this. There is still some good value, I think, to be had if you dig hard enough into the financials, and probably for a lot of other sectors. But I wanted to be diversified. So I wanted to get into a financial stock because even though I think the market has woken up to the fact that what I just said, the forward PEs are now higher than the prior PEs. The prior PEs made them look a lot more valuable than what they actually were. And they've woken up to the fact that it's temporary, right? But the good companies have saved a lot of this money, and there is a lot of equity now on their balance sheets, which means buybacks and increased dividends. So you want to look for those companies that are really good at value right now, really good values, and then you can look to buying into them as the dip happens, which that's what I did. And I'm going to continue to do it just a little bit with very select companies.
Can you name some names, sir?
Jefferies and Goldman Sachs. But Jefferies is what I bought already.
Goldman is traditionally for me. I've watched it over the years. The first year I started watching Goldman Sachs stock price was in 2005. Yes, I'm old. Traditionally over the years, they're a slow mover. They'll move 5 or 10%, but it'll take them a month or a month and a half to move it. They don't traditionally move that all in one day, like a lot of other stocks do.
Yeah, that's true, but a lot of deep values the same way. Jefferies, I fully expect to be that. I mean, it's had high volatility because it was a relatively new IPO, but I fully expect that as well. Bank of America was the same way. It was a very slow mover, and unless you held until recently, you didn't get a good return on it.
Well, Bank of America has been a very sideways mover the past few years. It's like, so we live in Cincinnati, guys, and there's a company out here called Procter & Gamble. You may have heard of it. If you're from here, people have always said, oh, I've made tons of money over the years with Procter & Gamble stock, and it gets reinvested, blah, blah, blah. And they would preach to me all the time, all about Procter & Gamble stock. And I was starting trading in the early 2000s. I started watching the stock market about 2002. I started actively trading with real money around 2004, 2005. And around 2006 and 7, actually, I think it was like 2009, I would tell these guys, I'm like, guys, Procter & Gamble hasn't moved at all. It's awful stock, awful investment. And they would look at me like I'm crazy. Yeah. And it's because these guys are these gentlemen I was talking to were in their 50s. They had bought it and held it way back in the day, and the company had split the stock multiple times. They did the dividend reinvestment. They raised their dividend. But from like 2000, 2010, it didn't move. It stayed in a $5 range, and it did not raise their dividend or nothing. It was altogether worthless. If you had your money in there, you made no money. And so I look at Bank of America the past few years, and it did the same thing just about. It had one move from 15 to 30. So it was at 15 forever, stayed at 15, then boom, 30, and now it's staying at 30.
Yeah. Well,
it's been around 30 the whole time.
Now there's but here's something to look for in regards to Bank of America. The Chinese Uber, Didi, is actually planning a IPO, and it is likely going to be a mega IPO here in the United States. They have robo-taxis, automated taxis that drive throughout China. I know Shanghai, they've got a big fleet there. So look for that, and they're tapping into Bank of America for that IPO, and I think Citigroup as well. So that may move Bank of America, maybe a play on Didi.
Are they going to do autonomous vehicles for these robo-taxis?
It is. That's what it is.
Is that what you mean by robo-taxis?
Yes.
I didn't know. Yes. I wanted to clarify. Sorry.
Yes. And now it's interesting. BIDU actually has in 3 cities in China too. They've got the autonomous taxis, and they got a permit to test in California. So that future is coming.
See that would American companies are salivating over that. You don't have to pay employees. There's no healthcare costs.
Mm-hmm.
I don't have to cover all this or that, especially in California with their strict rules. I'm sure Uber and Lyft are like, oh, yeah, we would love to do that.
Oh, yeah, definitely. But moving back here to the financials point, I said that I decided to buy Jeffries, so I want to give you some reasons here.
I tell you what, I would be a buyer of Uber if Uber had, say, San Francisco or LA filled with robotaxis. Be 100% buyer.
They're working on. I mean, I don't know what the regulations there are going to be. Who knows? Who knows what they're going to do? Because a lot of politicians want to get in the way of that.
Huge. I lived in California for years and years. Huge hurdles.
Yeah, lots. But as far as Jeffries goes, I mentioned that they're winding down on oil and gas and real estate assets. Their real estate assets, I mean, they didn't make too much money on real estate. $10 million, that's nothing to sneeze at. But the cost was $532 million on that. They're looking to sell, looks like right now, for about $542 million. But their Idaho Timber, they paid $86 million for that. They're going to sell it probably for around $165 million. This is probably going to happen over the course of the next 2 years. Lincoln, that's actually apparently a very large Italian telecommunications company. They bought this for $199 million. They're selling it for $685 million. So they're offloading these, I think, at the perfect time, in my opinion. I mean, maybe you argued that they should probably hold on to the oil and gas, but right now during the inflation and the situation where all these assets are going up way in value and in price, it's not a bad idea. So for me, Jeffries, not only a play on potential interest rates moving up, even though I think they're going to be trapped where they're at for a little bit, but it's also a play, I think, on inflation. And as well, I went back and I looked at this. I looked at Jeffries. Jeffries was a private company during the housing bubble and all of that. But they tend to outperform peers as a company during recessions. And that's a huge deal for me because what that does is that builds a base for future growth. When the growth comes back along, the cycle moves back into bullishness. So let's look at this. They consistently buy back stock, and they will continue to do so this year. They promised that at their annual shareholder meeting. And if you're going to look at, you don't only want reasons and, good catalysts to buy a company. Those aren't enough. When you're buying something, a stock in the situation, you want to look at like what the similar products are selling at, right? Like if you're going to go buy a house, it would make no sense to go buy a house and then not look at what the other houses on the same street in the same neighborhood sold for. So you need to compare. You need to compare these stocks to their peers. So let's do a little comparison here. Price to earnings ratio right now is around 6.99. Their peers, 19.04. Price to sales, 0.95. Peers, 8.66. Price to book is actually 0.79. Their peers are 10.73. Dividend right now is 2.56%. Their peers are at 1.77% on average. Their dividend, they've raised it by 15% in the past 12 months. Their dividend growth rate for 3 years is 20.95%. And that's really high. So you've got a greatly valued company here, in my opinion, and it's also a play on inflation. Eventually, I think the market will wake up to it. It might happen June 28th, which is when they report their next earnings.
Gotcha. I don't have anything to say. I mean, you covered everything. You built your case real well. I like it. I like what you have to say. I'm definitely taking a deeper look into it after this call.
And to me, they seem to be a good values-oriented company. I listened to some of their annual reports and things like that, and they talk about their employees very well. So I love that aspect too.
Very important because if you have a happy workplace, the company actually is more productive.
Yeah. So and you really with these companies, you really, really, really need to investigate the culture, in my opinion, so you don't wind up with a Credit Suisse situation or Archeogos or anything like that. So, yeah, I'm a big bull on Jeffries, and I think right now with these low interest rates, you should also be in low PE growth. It's all about the diversification. But if you're going into growth, go into low PE. I wouldn't really reach out. I know Peloton was up really high today, but as an investment, that's way too much money for me. That's way too expensive.
Peloton's legal issues, the fact that they mainly still only have one product. I mean, we covered Peloton in depth on one show. Their subscribers is where they're looking at the growth is the subscriptions. So I don't know about Peloton. I don't know if I wouldn't say they're tapped out, but you have a lot of competitions coming into the market right now. You have the Mirror, you have Tonal. There's a lot of these at-home things. And now that we're almost fully opened back up as a country, people are going to be heading back to the gym, doing things outside this summer. Those might pick up again come winter. Right now, I think they're going to lose some steam.
Yeah, me too. But for low PE growth, my pick is Baidu. Baidu is the Google of China. So if you're in China, instead of saying, "I'll Google it," it's I'll Baidu it. That's what you would do. But they also have a fleet of robo-taxis in China. They have them in 3 cities. They plan to actually expand these robo-taxis into being a national program. I mentioned that they have a test permit for China.
Question. You said Didi was the Uber of China,
yes.
Was the robo-taxis. And now you're saying Baidu is invested in it, correct?
They are. So they are now competitors, and Didi is a very huge competitor. This is actually probably going to be cut through competition, but I give the advantage.
So you're looking at basically like Uber versus Google in robo-taxis?
Yes.
But in China.
Yes.
All right.
Yes. And now here's the thing. Here's the advantage that Baidu has. Didi actually has a fleet of actual, like what you would recognize as Uber cars because they're actual people driving them. Their robo-taxis fleet is going to cannibalize their people driving fleet. Baidu doesn't have that problem because they don't currently have a people driving fleet. They're just focusing solely on the robo-taxis.
Yeah, also, from a strictly business maximize profit perspective, that's actually good for Didi, right?
Well, to have
you lose
both,
that overhead, right? You lose the overhead.
You lose the overhead. Yes, you do.
What's the highest cost of overhead to most companies is
labor.
People.
Yeah, it's labor.
It's just that.
Now, the other thing about Baidu and the robo-taxis, they're actually powered by Baidu's in-house AI called Apollo. So they're not outsourcing that. They're not, Uber, if they go into robo-taxis or autonomous driving, they're going to have to outsource for that technology probably. Baidu doesn't have to do that. They own it. And another thing that I found interesting about Baidu, they are a majority shareholder in one of China's most popular streaming services called iQIYI. I am probably not pronouncing that right. It's IQIYI if you're interested in that. This is actually the Chinese Netflix. They've got 106.9 million users. So this would be like if Google owned Netflix in the United States.
Nice.
But
which maybe we do.
As I mentioned, catalysts aside, you need to look at valuation. You need to look at how they're performing. So let's look at that. Their earnings per share for the trailing 12 months, 21.71. That is pretty high for a company that's trading below $200. Price to earnings ratio 8.59. Peers in this sector 36.01. Could you imagine an American company in AI and the internet having the biggest search engine in the country and autonomous vehicles trading with a price to earnings ratio of 8.59? No, me neither.
Wouldn't happen in the United States market today.
No. Return on equity, 24.43%. Their gross profit margin, 50.76%. Shareholders' equity increased 18.32% from last year. So I call Baidu a buy. I call Jeffries a buy. Those are my plays. Those are the 2 companies that I got into right before the Fed decision.
Not a bad move, man. Not a bad move. Right?
Yep.
All right, so guys, I want to be clear on my what I said about oil. I would like to think that these oil companies are going to go up. They just are not pumping out enough to make the same profit that they were before pre-March 2020. So since the rig counts are down half as much, they need oil to go up a little bit more before they get to that point of profitability. So I would say it's a watch. It's on my watch list. I'm watching it daily. I'm not a buy or a seller right now on that. Final thoughts, Brandon?
I'm honestly, right now, I'm just trying to make sense of what the market is doing. And I think we'll get better clarity in the next 2 weeks. Things should get a little bit easier.
Hopefully, right? Hopefully, right. Just a reminder, guys, I did finally sell that long-term NVIDIA position I had today. So feel free to hold it. You know, I thought it was going to go over 1,000. It still may soon, but I feel like we're going to have some volatility in the next few months.
Have they split yet?
Take a down. Has not, no.
When's that going to happen? Do you know?
I do not have an exact date, but I could get it by next show.
Okay.
Cool. All right, guys. So we hope that we've been entertaining, educational, uplifting, because we want everyone to make money. This is the Chinchilla Picking Podcast with Brandon Beaver, David Underwood. Please follow us on Instagram. Send us a like. Tell your friends all about us. Listen to the podcast. Follow us on Instagram. Have a good night, guys.